So in this lecture, we'll be talking about the market for foreign exchange. In the first part of the lecture, we'll be just introducing the structure of the exchange markets, and then we'll go into the details looking at how exchange rates are quoted. We focus on the spot market for today. So we look at how the exchange rates are quoted. We look at the bid-ask spread. We look at different ways that exchange rates are quoted, cross-exchange rates, and then finally we'll look at an arbitrage strategy based on exchange rates quotations. Yeah. So the focus of this lecture is pretty much on the spot market of foreign exchange. Okay. Guys, can you please mute your microphone because it's a little bit noisy? I wouldn't mind, but because this is recorded, so just in case when people listen to the recording, it could be a little bit noisy. Okay, so if you can you please mute your microphone? Okay. I don't know why it's still happening. If it's possible, can you please mute your microphone? Okay, so we are talking about the foreign exchange markets. Now, the foreign exchange market, very similar to many of the financial markets. This is a two-tier market in the sense that we have a wholesale section for interbank or for big financial institutions, and then we have a retail market for individuals like you and me. So the foreign exchange market is one of the largest financial markets in the world because it's very internationalized, right? So for foreign trade, when people want to do trades across the border, they have to exchange their currencies, right? So as a result, the foreign exchange market is a very big market in terms of trading volume. So this is an over-the-counter market, meaning that so you will have dealers. So normally financial institutions being banks, they act as dealers in the foreign exchange market. So what dealers do is that they stand in the market and they provide bid and ask quotes, right? So the bid quotes, the bid price is the price that they want to buy at, and the ask price is the price that they want to sell at, right? So for example, if you go to Commonwealth, if you go to any bank, any branch of any banks these days, you will see a electronic board, and they will show you the prices of different currencies, right? So when you pay attention, you will see that for each of the currencies, they will tell you a buy, and then they will tell you a sell, right? So the buy price is what we call a bid price, and that's the price that the bank is buying the currency at, and the sell price is the ask price, which is the price that they sell the currency at, right? You will also notice that normally the ask price is higher than the bid price, and the bank earns the spread in between, which is the bid-ask spread, yeah? So as we mentioned before, with the wholesale market, we have institutional participants like banks, big corporations, dealers, and also brokers, right? So brokers are the ones that help to help their clients to find the best prices in the market, yeah? We also have central banks in this market. So central banks, they trade currencies when they want to buy and sell their foreign reserves, right? So for example, if the Australian central bank, the Reserve Bank of Australia, wants to increase their foreign reserve, they will go to the foreign exchange market and buy, say, the USD, right? So central banks are also one of the big players in this market. Besides the wholesale institutions, we also have a retail segment of the market for you and me to exchange currencies. So in terms of the trading volume, if we break it down into different locations, we'll find that foreign exchange trading tends to be focused on in places where there is a finance hub, right? So, for example, the UK accounts for about 40% of the trading volume in the foreign exchange market, followed by the US, as well as some of the financial centers in Asia, right? So the trading of foreign exchange markets is also concentrated in the financial centers around the world. Right? So in terms of, this is the electronic FX conversations. So these are the messages between the different banks to settle their transactions. So if we look at the frequency of these messages, we will see that they tend to peak during the opening times of the big financial centers, right? So for example, during the trading days in Japan, or during the time when the European markets is opened, yeah? So these are the times when the big financial centers open, and that's where most of the trading activities happens, yeah? So how do banks maintain the records of foreign currencies in and out of the banks, right? So with the large commercial banks, they keep track of their foreign exchange through a system called correspondent banking relationship, which means that each of the banks, they will hold different accounts with one another, and each account is for a different currency, right? So what do we mean by that? For example, in this case, we have two banks. We have Bank A located in the UK and Bank B located in the US, right? So Bank A is a UK bank and Bank B is a US bank, yeah? So let's see how they settle their foreign exchange transactions between themselves. So suppose that at the moment, the exchange rate is for £1, we can exchange it to 1.25 USD. And at this exchange rates, for every 160 million pounds, we can exchange it for 200 million US dollars, right? So suppose also that we have a trader at Bank A who wants to buy the pounds, who wants to exchange the USD for the pounds, yeah? So Bank A wants to exchange the USD for the pound. So they would give Bank B the USD, and in exchange they receive the pounds, okay? So this is how the cash flows go for the two currencies in question. So let's see how this transaction is settled in the book. So as we mentioned before, in this example, Bank A wants to exchange USD for pounds. So they want to buy the pounds from Bank B, and in exchange, they'll give Bank B USD, okay? So the way it is recorded in their balance sheet is as follows. So as we mentioned before, for the settlement of foreign exchange between international banks, they will maintain different accounts for different currencies in their correspondent bank. So for example, Bank A, for Bank A, they will have a deposit from Bank B in the pounds, and they will also have a deposit from Bank B in the USD, right? So Bank B deposits some pounds and some USD in Bank A. Sorry, what did I say? So Bank A deposits some pounds and some USD in Bank B. So because this is Bank A's deposit in Bank B, it's recorded as an asset in Bank A's book, right? So this is Bank A's asset. in the liabilities side, so Bank B will open a deposit account with Bank A, and they will deposit their holdings of the dollar and the pounds in Bank A. So in Bank A's balance sheet, it will be recorded as a liability for Bank A because this is Bank B's deposit, right? So in this transaction, let's go back to this transaction. So in this transaction, Bank A is giving Bank B 200 million US dollars. And in exchange, they receive 160 million pounds, right? So because Bank A is giving Bank B's US dollars, when you give someone your money, then your money would reduce, right? So in terms of Bank A's asset, because they transfer $200 million to Bank B, it will be deducted from their deposit with Bank B, right? So they used to have $800 million with Bank B before. After this transaction, because they give Bank B $200 million, their asset in the dollar would reduce by 200. Okay. At the same time, because they received the pounds from Bank B, their pound asset would increase by 160 million pounds. Okay. Does that make sense here? So every time when you see an inflow in a currency, it will increase your asset. At the same time, if you have an outflow of a certain currency, it will decrease your asset. Yeah. So because this is just an exchange of currencies, so as we can see, there is an exchange between the two currencies here for an equivalent amount. The total asset size of Bank A does not change, right? So we used to have 1,900 million pounds. After the transaction, once we convert the pound, once we convert the dollar into the pounds at an equivalent rate, our asset size does not change. Yeah. So similarly for the liabilities side, so we're talking about the liabilities here. So through this transaction, because Bank A agrees to pay Bank B 200 million US dollars, because they are paying, so their liabilities increase by 200 million US dollars. In exchange, because Bank B pays Bank A 160 million pounds, the liability in the pounds would reduce by that amount, right? So we used to owe them 600 million pounds. Now we only owe them 440. Okay. So similar to before, because we are just converting one currency to another, there is no change in our liability side, right? Okay, so similar to the case for Bank A. So we look at Bank A before. Did someone do something? So we were looking at Bank A's balance sheet before. Now let's look at Bank B, right? So we have exactly the same transaction as before. But in this case, we are looking at the other bank, right? So we're looking at Bank B. Did someone just highlight on the slide? Quite interesting. Anyway, so so for Bank B, if we stand from the point of view of Bank B is receiving the US dollars, and in exchange they are paying the pounds, right? So in terms of their asset, we should expect to see an increase in their dollar holdings and a decrease in their pound holdings, yeah? So in their dollar holdings, because they're receiving the USD. So we should see an increase in the dollar holdings. And at the same time, because they are paying bank aids in the pounds, we should see a decrease in their pounds holdings. Yeah. So once again, because this is an exchange between the two currencies, there's no real change in the asset size of the bank. We started with 2,130. We still end up with 2,130, right? In the liability side, so this is Bank B's liabilities. So in this transaction, because Bank B agrees to pay Bank A in the pounds, so their liability in the pounds should increase. At the same time, because they receive the USD from Bank A, their liability in the dollar should be reduced, right? So once again, we end up with the same liabilities because we only exchange currencies. Okay. So is that okay? So example number 2. So I did example number 1 before. Now, can you guys help me do example number 2? So in example number 2, we have 2 banks again. We have one bank in Italy and one bank in the UK. So Bank X is from Italy, right? And Bank K and Bank Y is from the UK. Okay. So X and Y. So currently the exchange rate is for every pound we can change it for 1.1 euro, which means that if we want to exchange 100 million pounds, we can exchange it for 110 million euros, right? So in this case, this is the transaction that we are dealing with. Now we have an employee at Bank X, and they want to buy the pounds, right, for the euro. Okay. So in this case, X wants the pounds, so they want to receive the pounds, and in exchange they are paying Y in the euro, right? So we would see 2 different cash flows in 2 different currencies. For X, if we are Bank X, then we expect a cash inflow in the pounds, and then we expect a cash outflow in the euro, right? And it's the opposite for Bank Y. So if this is the case, if this is the transaction that we are dealing with, can someone tell me what happens to the assets of Bank X? So let's start with this one first. Now for the next few minutes, I think I'm going to try a new technology that I just learned with Zoom. I'm going to break you guys up into different rooms, different discussion rooms. And when we come back, can you let me know what will happen to these banks, right? So are we ready? We have 29 participants, so I think I'm going to break you guys into, say, 4 different rooms. Is that okay? Yeah. I think I'm going to break you into 5, just to make it. And that will be very random, right? I'm just going to randomly assign you guys to different rooms. So once you come back, can you please tell me the answer? Okay, so I think I have already assigned you guys into different rooms. So let's work through this problem for 1 or 2 minutes, and then I'll invite you guys back to discuss, yeah? Someone have a chat. Okay, so let's come back. Let me see if anyone is still there. We've got 2 people that are still there.
Hey, sorry, I just have a quick question.
Yes.
So, just the point that I'm confused about. So, are you saying that every bank of these has a separate deposit opened at the other bank and they just transfer the money over? Or is the actual transaction happening in real time between the 2 banks?
The transaction happens in real time between the 2 banks. Yes.
Okay.
Yeah.
And the only reason we have the assets and liability is just to show the change in the reserves holding in each bank, correct?
Exactly. Yes.
Awesome.
Yeah.
That
Sorry,
checks
it's
out then.
tedious. We just want to
Yeah.
show how it happens. Yeah.
Okay. All good. That checks out then. Thank you.
Guys, if we are using the chat room, we please use English? I can't understand other language, just in case you guys want to say something. The chat room will also be recorded, right, for your information, just in case. Okay, so what do we think? So let's look at Bank X first. Through the group discussion, what do we think would happen to the assets of Bank X? So with Bank X, we are receiving the pounds, right, and we are paying the euro to Bank Y. So does someone want to tell me what happened to their asset side? In terms of their pounds holdings, do we expect to see an increase or a decrease? Someone talk to me. Someone talk to me.
Increase.
We want to see an increase, yes? So this should be an increase because we are expecting a positive cash flow, yeah? Similarly, for the Euro holdings, this should be a decrease, right? Because we're paying to Bank X. So it's an increase here. Oopsie. Yeah, anyway, so similarly with Bank, on the other side of the transaction, we have Bank Y, where Bank Y receives the Euro from Bank X and they pay pound, right? So because they are paying the pounds, we would expect to see an increase in the pounds for their liability.
Hey, yo, Sneezy, what's you doing, bro?
Paul, I'm sorry, I can hear you from here. Paul, you need to mute.
What? Seven.
My man, we in class. Mute your mic, man.
Guys, if you need to talk in private, can you please mute your microphone? Yep, JC, that's the right answer. Thank you so much. Anyway, so let me go back here. So with the so we're just looking at the pounds here. Let me just do this first. So where were we? So in terms of the asset side of Bank X, so because we are paying the euros right to Bank Y, we would expect to see a decrease in the euro holdings for Bank X on their asset side. In their liabilities, it's the opposite, yeah, because they are receiving the pounds, their liability reduced, their liability in the pounds reduced, and their liabilities in the euro increases, right? Similarly for Bank Y, so for Bank Y, because we are receiving the euros, so on our asset side, there is an increase in the euro, and there is a decrease in the pounds, right? On their liabilities is the opposite, okay? So there is an increase in the pound liabilities, but there is a decrease in the euro liabilities, okay? So throughout all of these transactions, we will see that the size of their assets and liabilities should be the same, okay? All right, so the way that banks communicate about these transactions are through the following systems. So you've got the SWIFT system where the messages, this is for the messages between the banks. We also have a clearinghouse interbank payment system. This is for, so the job of a clearinghouse is to settle transactions between different banks, yeah? Similar to the clearinghouse function of the Australian Stock Exchange, for example. Okay. Similarly with ECHO, this is just a clearinghouse for international transactions. Yeah. So these are the institutions that deal with settling the transactions that we talked about on the previous slide. Okay, so for the next few slides, we're going to be talking about how a currency is quoted. So how do people quote the prices of currencies in the spot exchange rate market? Yeah. So as we mentioned before, in the exchange rate markets, we have a over-the-counter market or a dealer market where you have a bid price and you have an ask price. So for any of the currency pair, you will see two different prices, yeah? So you will see an ask price and you'll see a bid price. Also in terms of currency, in terms of terminology, we differentiate between the quoted currency and the measurement currency, right? So the quoted currency are the currencies that you are trying to price. say, for example, if I give you this quote. So if I give you this quote here, so in this case, we are quoting the price for the Australian dollars, yeah? So this quote here tells you the price of $1 Australian in terms of the USD, okay? So in this case, the quoted currency is the AUD and the measurement currency is the USD, yeah? So the measurement currency is the units or the price of the other currency. So also throughout these examples, I'm going to be assuming that the US is our home country, just because the textbook uses, the textbook is written by two US academics. So they use the USD as the home currency, right? So just to be consistent with the textbook, I'm going to assume that the USD is the home currency. Okay. So in terms of quotation, we've got two different ways that we can quote a currency. So a direct quotation is when we price the foreign currency in terms of our home currency, right? So a direct quotation is the price of one unit of the foreign currency in terms of our home currency, right? So for example, in this case, if we're trying to price the Japanese yen, right? So the Japanese yen, from a US citizen's point of view, they are a foreign currency, right? So in this case, for a direct quotation of the Japanese yen, I'll be saying that for each of the yen, it is worth about 1 cent of the USD. Okay. An indirect quotation is when you price the home currency in terms of the foreign currency, right? So this is the price of the home currency in terms of your foreign currency, yeah? So using the Japanese yen as an example to be consistent with the previous example. So in this case, we are saying that the price of $1 US is equal to 100 yen, okay? So in terms of the notation, you'll see that later on as well with the nouns. So this is a currency quotation, right? So if I want to quote the USD in terms of the Japanese yen, I'll be writing this, okay? Oopsie, this is a indirect. This is a direct quotation. So it should be USD per yen. Sorry, I'm a bit messy here. I don't have a normal projector like before, so I'm going to just write on the PowerPoint slide. So with the indirect quotation, we are writing this, yeah? So say for example, let's take this quote for example. I'm saying that 100 is the amount of yen equivalent to 1 USD, right? So this quote means the number of yen per USD, okay? Okay, so as an example, let's look at an actual currency quote from a financial paper. So, for example, if we look at the spot market for May 16, 2016, and if we look at these quotes over here. So what these quotes means is that for the British pounds, the first column is the price of the British pound in USD. And for the second column, it tells us the number of pounds that is equivalent to each USD, yeah? Does that make sense? So in the first number, this one tells me the value of the pounds in the USD. in the second number, this number tells me the value of the USD in terms of the pounds, right? Does that make sense? So if we use the direct and indirect terminology, then we can say that the direct quotation is 1.4402. So we are pricing the foreign currency, which is the pounds here, in terms of the domestic currency, right? Note that the USD is assumed to be the home currency, right? The indirect quotation is the price of our home country, our home currency, in terms of the foreign currency, yeah? So this is saying that each US dollars is worth about 69 cents of the pounds, right? Also, something to pay attention to, this will be very useful later on. You will see that the price of one currency is the reciprocal of the price of the other currency, right? So the direct quote is the reciprocal of the indirect quote. Okay. Okay, so we will talk about the bid-ask spread as well. So as we mentioned before, when you have a dealer market, right, normally the dealer will quote two prices. One is for the price that they want to buy, and one is for the price that they want to sell, right? So if the bank quote a bid price, then that is the price that they are willing to buy at. And as the customer, as the retail customers like you and me, we would trade at the opposite side, right? So if the bank is willing to buy at $2, for example, that means when we want to sell the currency, we will be selling at their buying price, right? Does that make sense? Similarly, if a dealer quote an ask price, that is the price that they want to sell at, right? So as a customer, if we go to the bank and we trade with them, we will be trading at their opposite side, okay? So if we want to buy, we'll be buying at their selling price. So the bid-ask spread is just the difference between the bid price and the ask price that are quoted by the bank. So normally the ask price will be higher, so the bank will be selling the currency at a higher rate than they are buying, so that they will earn the profits, they will earn the spread in between, right? So their profit here is the bid-ask spread, okay? So as an example, let's look at one example over here. I can't find the mouse here, right? So let's say Commonwealth give me a quote for the USD, right? So let's say the currency that we are dealing with is the USD. Now let's say Commonwealth wants to buy USD at 1.2 Australian dollars, and they want to sell the USD at 1.3, right? Let's assume also that we have National Bank of Australia. For the same currency, for the USD, they are giving me these two quotes. Okay. So these quotes mean that, for example, for CBA, they are willing to buy the USD at 1.2 and they are willing to sell the USD at 1.3, right? So suppose that I want to buy the USD as a client, yeah? So suppose that I want to go to a bank and buy a USD. If I am a buyer, do I want to buy from CBA or do I want to buy from NAB? So which bank is more attractive to me if I want to buy the USD? Did someone want to tell me the answer? Yes, there's something in the chat room, right? So Leah says that she wants to buy from CBA, right? Spot on. So if I am a buyer, if I want to buy USD, I'll be looking at the ask prices from these two banks, right? I'll be comparing the two ask prices. And because I want to buy the USD, I want to buy at a cheaper rate. So in this case, the cheaper rate is from CBA, which is 1.3, yeah? So for a buyer, I'll be hitting this price. Alternatively, if I want to sell the USD, where do I go? Yes, let me see. I want to go to NAB, right? Yes, spot on. So I want to sell to NAB. Well done, Leah. So because they give me a higher price, yeah? So as a seller, I want to sell the USD at a higher price, and therefore I'll go to NAB, okay? Okay, so in terms of the bid and ask spread, as we mentioned before, normally banks will quote a higher ask price relative to the bid price, and they earn the difference, yeah? So the difference is the profit that the banks earn. To calculate the percentage profits, we can use this ratio over here. So to calculate the percentage bid and ask spread, we take the ask and we minus the bid. We divide it by the bid rate, yeah? I think there was a typo on the lecture slide before where I said this is ask. It's not correct, it should be the bid rate, yeah? So applying that to these quotes over here, if I compute the bid and ask spread for this bank, I'll find that they earn about 0.44% of profit. Oopsie. This is just an example similar to what we saw before. So in terms of the terminology, again, this is not very important, but normally exchange rates will be quoted in 4 digits. So you'll normally see a 4-digit number for an exchange rate quotation. So the first two digits are called the big figure. So normally all banks will have the same big figure. The last 2 digits are called the small figure, and these will be different for different banks, right? So it's just a quotation terminology matter. Okay. So let's look at how we combine when we combine the bid and ask prices and the indirect and direct quotation together, right? So when we combine them together, how does the bid and ask look like? So if we look at this example here, so in this case, we have a quote for the euro against the USD, yeah? So in American terms, so this is the direct quotation. We are pricing the euro in terms of the USD, yeah? So for this particular bank, they are buying the euro at 1.125 and they are selling the euro at 1.1255, yeah? So if we convert these ratios into the indirect quotation or the European terms, where these are the prices of the USD in terms of the euro, right? Okay, we will find that the bid rate for the American term is the same as the ask rate for the European term, right? So how do we interpret that? So the way that we understand this is that if we think about a currency exchange, by definition, this is an exchange, right? So we would have one transaction for the euro and one transaction for the US, yeah? So every time when a bank sells a euro, when a bank exchanges a euro for the USD, they effectively sell the euro, and at the same time they buy the USD, right? So for every foreign exchange transactions, you would have two different currencies. When you buy one currency, that means you are selling the other currency, yeah? And as a result, the bid price for one currency would be the reciprocal of the ask price for the other currency, okay? So when CBA buys the euro, that means that they effectively sell the USD as well, okay? So their bid rate for the euro should be the same, the reciprocal of the ask rate for the USD. It's the same thing for the ask rate for the euro and the bid rate for the USD as well, right? So when we sell the euro, that means we are buying the USD, okay? So let's work through an example to illustrate what we mean by that. So for example, in this case, we have an American trader and he wants to take a position in the pound, right? So when you want to take a $10,000 position in the pound, what it means is that you want to exchange your USD to the pounds, right? So you want to exchange your USD to get the pounds. Okay. So as a trader, so this is the client, right? When he goes to a bank, he sees these two quotes here. So for the first quote, this is the price of the euro. Sorry, this is the price of the pounds in terms of the USD, right? So this is the bid price and this is the ask price. So what these prices means is that the bank is willing to buy the pounds at 1.25 and they are willing to sell the pound at 1.2505, okay? Similarly, for the second quote, this is the invert of the first quote. So this is the price of the USD in terms of the pounds, okay? So these quotes means that the bank wants to buy the USD at 0.7997 and they want to sell the USD at 0.8, okay? So 00 means 0.8, so we just go up to one figure. So the question here is, after his trade, what would be his position, right? So what do we think? So in this transaction, what are we trying to do? So in this transaction, if we talk about sell and buy, right? Are we trying to sell the USD or are we trying to sell the pounds as the trader? If I exchange 10,000 USD to the pounds, am I selling the USD or is there an outflow of USD or is there an inflow of USD? Here we go. We sell USD, right? Spot on. So in this case, we are selling the USD. So because it's a sell, it's a cash outflow, I'm just going to say it's the negative cash flow, right? So we are selling the USD and we are buying the pounds, right? So because we are a client, when we go and sell the USD, Are we selling at the bid price? Or are we selling at the ask price? So if I'm a client, I will be trading at, yes. We'll be selling at the ask price. So we are a client, right? So we are trading against the bank. So the bank is the dealer in this case, yeah. So when we trade against the dealer, we'll be trading in the opposite side, right? So if I am selling the USD, I'll be selling at the bank's bid price because that's the price that they buy at, yeah. So this is very important to understand because later on, that's all we'll be doing, right? Sorry, this is the USD. So when I'm selling the USD, I'll be selling at the bid rate of the bank, right? So the bank is buying at their bid rate. So when I'm selling, I'll be selling at their bid rate. Okay. Similarly, if we are talking about the pounds, now because we are buying the pounds, we'll be buying at the bank's ask rate. Okay. So we'll be buying at the opposite side, right? So if we talk about buying the pounds, we'll be looking at this right over here. Okay. So let's look at the USD for the moment. So if we are talking about the USD, we are basically selling, right? So when we are selling, we'll be selling at this rate over here. Okay. So to convert 10,000 USD into the pounds, I'll take 10,000 USD and I'll times the value of the of each of the USD, right? So this is the amount of USD I have. If I times it by the value of each USD in terms of the pounds, I will get the equivalent pound number. Okay. So in terms of currency exchange, it could be quite confusing. So one way to remember that is to think about this cheap way. So what I have here is if I have a USD amount, right? So this is my USD amount. And if I want to end up with the pound on the right-hand side, then I want the pound to be on the top, right? So I want the pound to be on the numerator of my currency, of my exchange rate. And I want the USD to be in the bottom, right? To be the denominator, okay? Why is that the case? Because these two can cancel each other out, right? Leaving me with the pound, okay? So this is a cheap way to think about which exchange rate to use when you do the calculation, yeah? I find it's very useful to avoid any mistakes when you do the calculation. So let's look at the other way, right? So if we want to think about the pounds, so in this example, we are selling the USD to acquire the pound, yeah? So we are buying the pounds in this case. So as we mentioned before, if we are buying the pounds, we will be buying at the bank's ask rate, yeah, which is this rate over here. So how do we convert 10,000 USD into the pounds? Using the ask rate, the direct ask rate. So similar to before, we want to think about exchanging currencies in this way, right? So we start with the USD. And if we want to convert it into the pounds, we need to be using this exchange rate over here, right? Now, unfortunately, because we're looking at the direct ask rate, our exchange rate looks like this. So to convert from this to this, we want to take the reciprocal, right, of the direct ask rate. Okay, so we want to take 1 divided by the direct ask rate, which is 1.8. 2505, 2505, and that will give us this ratio over here. Yeah. So once again, just to check, we want to make sure that if we start with the dollar, then the dollar should be the denominator, right? So that these two cancel out, and we are left with the pounds. Okay. So from the past, I find that these kind of calculations could be quite confusing, but it doesn't. It is not very hard, right? It's not very hard. Trust me. It just takes a few practices to get used to the way currencies are quoted. Once you're familiar with the concept, once you're familiar with the currency pair, then these calculations will be very easy. I promise. Okay. Okay, so we have done this example before. Now let's take it to a more realistic case, right? So in this case, we are having a businessman who is having international trades around the world. So in this case, he just completed 2 transactions, one in Italy and one in England. So for the 2 transactions, he get paid in the euro and in the pounds, right? Because he's a US citizen, he wants to convert these back into the USD. So when he goes to a bank, he gets 2 different quotes, as we see on the slide. And the question here is, assuming that there's no other fees, what are the US proceeds from his transactions, yeah? So when he converts the 2 transactions back into the USD, what does he get, right? So let's take a few minutes to work through the problem. So in this case, you need to have 2 calculations, one for the euro transaction and one for the pounds. I'll leave you guys for about 2 to 3 minutes. When we come back, let's go through the calculations together, yeah? I'm going to be putting you guys into different break rooms as before, so that if you want to discuss anything with your friends, you will be able to do so. All right. Okay.
Man, that was a hard question. Sheesh.
Well, you have a question?
Oh no, I was just having a little trouble with it, but I think I got it done. Thank you, though.
Okay, I think we have been back from the break room. So how did we go, guys? How did we go with the two transactions? So if I want to convert the euro, so 2,500 euros into the USD, how much would I get? And what rate am I looking at? Someone talk to me or someone chat with me. Right. So I want to walk you through the first transaction and you guys can tell me the second transaction, all right? So if I have 250,000 euros and I want to convert it into the USD, effectively I'm selling my euros to acquire the USD, yeah? So in this transaction, this is my euro. It's so hard to write using the mouse. So I'm gonna be selling my euro to acquire the USD, yeah? So when I sell, I just put a minus sign here. When I buy, this is a positive sign, right? So if I am a client wanting to sell the euro, I will be selling at, I'll be selling at the bank's bid price, right? So from the two quotes that we have, with the second quote, that's related to the euro. So this is the price of the euro in terms of the USD, right? So when I'm talking about the euro, I can apply these rates directly. So because I want to sell the euros, I'll be looking at the rate on the left-hand side, yeah? So I'm selling at the bank's bid rate. As a customer, I'll be trading at the opposite side, yeah? So if I want to convert my euros into the USD, I'll be using the bid rate from the previous slide, which is this rate over here. I've got it here as well. Okay. So to convert the euro into the dollar, if I start with the euro and I want to end up with the dollar, then I want the dollar to be on the numerator and the euro to be on the denominator, right? So if I look at the exchange rate that I'm given in the question, it's exactly the same as the one that I'm given in the question, right? So what I'll do here is that I'll just take the 250,000 euros and I times the exchange rate that I have in the question, okay? Which is 1.125. So if I do so, I will find that the amount of dollars I get for the first transaction is about 281,000, okay? So are we all good with the first transaction? What about the second transaction, right? So in the second transaction, I have the pounds and I have the dollar. Now, because I'm exchanging the pounds for the dollars, that means I'm selling the pounds to the bank and I acquire the dollars, right? So when I sell the pounds, I'm just going to write a minus sign here to remind me that it's a sell. And when I acquire the USD, I'm just writing the plus, so it reminds me that I'm going to acquire the USD. So I'm going to buy the USD, yeah? So looking at the quotes that we have here, so the quote that we have here related to the pound is the first quote, right? So this is the quote I'm looking at. So this quote is the price of the USD in terms of the pounds, right? Are we following? when you see the USD on the right-hand side of the exchange rate, then that is the currency that we are trying to price. Yeah. So here, the exchange rate here is the value of the USD in terms of the pound. So for example, 1 USD is equal to 0.7997 of the pound. So if we are talking about the USD, from the analysis that we did here, we know that we are going to buy the USD, yeah? So if we are buying the USD as a client, we will be buying at the dealer's ask price, okay? So we will be hitting the right-hand side of the quote, okay? Which is this one over here. So when we buy the USD as a client, we will be buying at the dealer's ask price, okay? So, which is here, okay? So if I have 500,000 pounds, and if I want to convert it into the USD, this will be the equation, right? So I've got the pounds here. I times it by USD divided by pounds. So that these two cancel out, and I will be left with the USD. Okay. So if this one is on the numerator, it will go here. Okay. Which is here. So if I sum up the two transactions, I will find that the total sum is about 906 US dollars. Okay, 906,000 US dollars. So these exercises show you how to convert from one currency to another using the correct bid and ask price, the correct direct and indirect quote. Okay, so I know it could be a little bit confusing in the first time that you come across with it. But I promise over time, when you practice a few more times, it will be very easy, right? So it's just a matter of getting the right quote for your calculation, okay? So also, whenever you see a quote, you need to be, let me just check the chat session, someone say something. Why we sell euro but buy pounds? Sorry, I'm confused. I'm not buying pounds here, I'm selling the pounds here. In the second transaction, I'm buying the USD, right? That's a very good question. So in the first transaction, we are talking about selling the euro, but in the second transaction, we are talking about buying the USD, right? So why is that the case? Why did I talk like that? It's because I'm looking at, I'm just trying to be consistent with the quotes that we have, right? So in the first transaction, we have the price, we have the quote of the euro in terms of the USD. So it's easier for me to talk in terms of the euro, okay? In the second transaction, because we are given the quote of the USD in terms of the pounds, so it's easier for me to talk in terms of the USD, right? So the USD is the commodity currency in this case. So one thing to notice is every time when you see a quote, when you see a bid and ask quote, normally for a bank, their bid price will be on the left and your ask price will be on the right. But for you as the client, whenever you buy, you'll be buying on the right-hand side, right? So you'll be buying on the opposite side of the dealer, okay? So if they are selling, you are buying, and if they are buying, you are selling, okay? Does that make sense to everyone? Okay, questions? Yep, okay, thanks, Leah. Okay. So we talk about the case when we have a direct quotation, right? So in these exercises, for example, if I want to convert the USD into the pounds, I will use the first rate. And when I want to convert the USD into the euro, I'll be using the second rate, right? So with this calculation, we can use a direct quotation. We can use a direct exchange rate for these calculations, yeah? But sometimes when we convert currencies, we might not have a direct exchange rate for these currencies, in which case we have to use a cross rate, yeah? So what is a cross rate? So a cross rate is an indirect way that we can work out the value of two currencies. For example, in this case, in this example I have here, where's my mouse again? So in the question, we are given two different quotes. We are given the USD and Euro quote. And this is 1.05. We are also given the USD and the PAL quote. And this is 1.25. Right, so from these questions over here. Now, suppose we want to convert the euro into the PAL, right? In this case, we don't have a direct exchange rate between the euro and the PAL, and we have to work it out based on the two exchange rates that we are given, okay? So if we want to find the value of the PALs in terms of the euro or vice versa, we need to compute a cross rate, okay? So how do we do so? How do we compute a cross rate? So if we want to find this exchange rate, so if we want to find the value of the euro in terms of the pounds, and we have the USD in the middle. So this is how I will be thinking about these exchange rates, yeah? So we know that we have to work this out based on two different exchange rates involve the USD. Okay. So if I rewrite the exchange rate between the pounds and the euro in terms of these two exchange rates, I will find that these two terms cancel out, leaving me with the exchange rate that I want, which is the pounds and the euro, right? So let's work through this problem. So suppose I want to find the exchange rate between the pounds and the euro like this. I will start with these two exchange rates first. So the first rate that I need for this calculation is the pound against the USD, right? So do we have that in our question? So in our question, we are given the reciprocal of this ratio, right? So we are given the ratio between the USD and the pound, but we want the ratio between the pound and the USD, okay? So it's just the reciprocal of this rate over here. What about the second rate? So with the second rate, it's just the USD divided by the euro, which is what we are given here, okay? So in this case, therefore, I'm just going to times it by what is given in the question. So through this calculation, the answer here is 0.84, meaning that for every euro, I can exchange it with 0.84 pounds, right? Okay, the next bit is going to be super confusing. I'm sorry for that. So I'm going to give you guys 1 minute to think about the cross rate first to get your head around this calculation here. So after 1 minute, we'll come back and talk about the cross rates for bid and ask. Right. Okay. So now that we understand how to calculate a cross rate, let's apply that to work out the cross bid and ask rates. Okay. So in this case, we have a little bit more work to do because we have bid and ask, and then we have the cross rates as well. Okay. So what we have here is we are given two exchange rates. So we are given the exchange rate between the pounds and the USD on the first row, and on the second row we have the euro and the USD. Right? So the same problem as before. Now suppose that we want to work out the value of the pound and against the euro instead of the USD. Then how do we do that, right? Given the bid and ask rate and everything. So let's look at the case for the bid rate first. So this is the rate that we are looking at, right? So we're looking at the exchange rate between the euro and the pounds. Yeah. So with these exchange rates, we are trying to work out the value of the pound in terms of the euro. Okay. And this is the bid rate. Okay. So to think about how to calculate the cross bid rate, when we talk about the bid rate, we are talking about the rate that the bank is buying the pound at, right? So because it's a bid rate, this is the rate that the bank is buying the pound at. Okay. So let's consider this from a customer's point of view, from a client's point of view. So when the client starts with 10,000 pounds, and when they sell the pounds to get the dollar, after that they will use the dollar to exchange for the euro. This strategy would be very similar, would be equivalent to a strategy when a client goes to sell the pounds to the bank to get the euro, right? Okay. So the reason why the customer is selling the pound here is because they are selling to the bank, right? So they're selling at the bid rate to the bank, okay? So when we start with 10,000 pounds and we want to convert it into the euro through the two exchange rates that we are given in the question, this is how we can do the calculations, right? So let's start with 10,000 pounds first. Now suppose that we have 10,000 pounds and we want to sell the 10,000 pounds to get the USD, right? So we want to use the first quote to exchange the pounds into the USD. So as a client, when we exchange the pounds to the USD, when we sell the pounds, we will be selling the pounds at the bank's bid rate, right? So we'll be selling at this rate over here, which explains the first exchange rate here, okay? So this is the pounds, this is the USD, and this is the euro, okay? So once we sell the pounds and we obtain the USD, what we will do next is that we will sell the USD to obtain the euro, right? So in the second transaction, we are exchanging the USD for the euro, okay? So when we are selling the USD in the second transaction to acquire the euro, because we are selling the USD, I'm looking at the last two columns here. So these are the price of the USD, right? So when we are selling the USD to attain the euro, we will be selling at the bank's bid rate, right? So we'll be selling at this rate over here. So if we are selling at the bid rate, remember that the bid rate for the USD is equivalent, is the reciprocal of the ask rate for the euro, right? So this ratio is the reciprocal of this ratio over here, okay? So this is equal to 1 divided by 1.0510. So this explains the second bit in our calculation here, right? So for the second calculation, for the second transaction, we are exchanging the dollar to the euro, and the rate that we are looking at is this rate over here, right? So when we take the reciprocal of this rate, we will find that it is this rate over here, okay? So through these two transactions, we will be able to convert the pounds into the euro, okay? So this is not a direct calculation because we have to cross two different exchange rates, yeah? So effectively, okay, I think we are back now. So effectively, we have converted 10,000 pounds into 11,418 euro, so that the exchange rate between the pounds and the euro is 1.1418, right? So if we take 11,418, we divide that by 10,000 pounds, we will get this ratio over here, okay? So through this calculation, we have calculated the effective cross bid rate for the euro and pound exchange rates, okay? So one more thing to note, now if we pay attention to these exchange rates here, so as we calculated the cross bid rate, it will be the reciprocal of the ask rate for the euro, right? For the euro currency. So this will be the reciprocal of this rate over here, okay? So similarly, if we want to calculate the cross ask rate, we would consider a situation where the customer wants to sell the euro for the dollar, and then they want to buy the pounds back, right? So similar to the exercise that we did before, when we have 10,000 euro, if we sell the euro to acquire the dollar, we'll be selling at the bid rate for the bank, right? So as a customer, we are selling the euro at the bid rate. So once we get the dollar, we then use the dollar to buy the pounds. So when we buy the pounds, when we sell the dollar, we'll be selling at the bid rate. Which is the reciprocal of the bank's pounds ask rate. Okay. So through this transaction, I'm just going to point an arrow here so that you know where it comes from. So through this transaction, effectively, we have converted 10,000 euros into the pounds. So if we take 8,400 pounds, we divide it by the number of euros, we will find that the exchange rate here is, for each euro, we will get 0.84 pounds. Okay. So similar to before, the cross-ask rate for the euro, for the pound, would be the reciprocal of the cross-ask rate for the euro. Okay. So I know this is very confusing and it takes a lot of practice before you get used to it. But think about, so when you practice the problem at home, start with this, right? So you start with this transaction here and you're trying to work through this transaction and then calculate the effective exchange rate afterwards. Yeah. So start with this and work through the problem. Okay. So to summarize the exercise that we have been doing before. So with the exercise that we did before, we have calculated the cross bid and ask rate for the euro and pound currency pair from the two exchange rates that we have here. All right. So from these two calculations, from these two numbers, if we take the reciprocal of this bid rate over here, we will get the ask rate for the euro. And if we take the reciprocal of the ask rate here, we will get the bid rate for the euro. Okay. So we have 15 minutes left for the lecture. So I think given that we need to practice a few times to be familiarized with these sort of exchange rate calculations, for the next few minutes, I'm just going to be discussing the general idea of how to conduct an arbitrage strategy in the foreign exchange market. Yeah, I'm not going to go through any detailed calculations in the next few minutes. We'll just be discussing about the general idea so that we understand what to do for the next week. Yeah. Let's skip through this example here. We can go back next week. So it's very important that when we go home, let's practice a few times the calculations that we have done in the lecture today. Yeah. So in terms of currency exchange rates, there will be a few arbitrage opportunities that we'll be talking about. So if we classify arbitrage opportunities in the foreign exchange markets into two types, we've got a bilateral arbitrage opportunity. So in this case, we are dealing with just two pairs of currencies, right? For example, if I have a country that quotes, say if I have the Australian and the USD currency pair, say in Australia, the exchange rates could be, I'm providing a direct quotation for Australian investors here. So for every US dollars in Australia, you can trade it at 1.5. However, in the US, with the same currency, if you trade it at 1.4. So in this example, when we have the same currency pair, And if they are traded at two different prices in two different locations, then there is a potential for a arbitrage opportunity, right? So when we say bilateral arbitrage, we are referring to one particular currency pair, and it is traded at two different prices in two markets, yeah? So in this case, assuming there is no transaction cost, if I want to take advantage of this situation, I'll be buying the USD in the US, and I'll be selling it in the in Australia, right? So I buy at the market where it's a little bit cheaper, and I sell at the market where it's more expensive, right? So the spread here that I earn is 0.1. Okay. So the second type, the more common type of arbitrage in the foreign exchange market is called a triangular arbitrage. So in this case, one second, someone has a chat. So why does the bilateral arbitrage happens? Sometimes it just be a mispricing. It could just be a mispricing, right? So sometimes people in Australia might think that the US dollar is worth 1.5, but in the US they might think that it's not worth that much. Yeah. So there could be differences in investors' expectation about the currency. Some other times you might see that there is a discrepancy in the pricing between two different countries, but it could reflect transaction costs more than anything, right? So for example, in the US, for example, maybe it's just more costly for the dealers to run the market, and therefore they undercut the exchange rate a little bit to compensate for that, yeah? So sometimes it could be due to investors' expectation in different markets, and sometimes it just reflects a different trading costs in different markets, yeah? So as you alluded to before, Ken, with bilateral arbitrage, these are normally mispricing opportunities, and normally they don't last very long, right? So the mispricing would only last for a few minutes or so before people realize it and they start to trade on it, okay? With triangular arbitrage, this is when we are dealing with more than two currencies. So the exercises that we are going to do through the lecture and through the tutorial next week involves typically 3 different currencies. So when you have more than 2 currencies in place, sometimes the cross rates between the currencies don't align, and that is when you have an arbitrage opportunity, right? So what do we mean by that? I'm just going to go through this problem very briefly, and when we go back next week, we can talk about it in more detail, right? So for example, in this case, we have a triangular arbitrage opportunity in the sense that we have 3 different currencies. So we have the pounds, we have the dollar, and we have the euro. And we will see that they are traded at different prices in different markets, yeah? So, for example here, if we compute the cross rates between the euro and the pound from the first 2 exchange rates, we will find that the cross rates for this exchange rate is given here on the slide. And if we compare that with the actual quoted rate from the third bank, we will find that there is a little bit of a misalignment, okay? So what do we mean by that? So the misalignment here is that for a trader, for an arbitrager, now remember that we are a trader, right? So we'll be trading at the opposite side of the banks. So for a trader, there is an opportunity for me to buy the pounds at this price from the third bank at 1.14, and then I'll go and sell the pounds to the first 2 banks indirectly through the first two banks at this rate, right? So I can buy at 1.14 here, and I can sell at 1.1418, okay? So through this exercise, I can find that I can earn a spread of about 18 basis points, okay, per pound. Right, so when we talk about misalignment in triangular arbitrage, we are thinking about how a trader can profit from buying low and selling high, okay? So as we mentioned before, as soon as you have a bid and ask price, you need to be very careful, because for a trader here, they will only profit if the ask price from the third bank is lower than the bid price from the first two banks, okay? So taking into account the bid and ask spread, even after paying the bid and ask spread, the trader now can still earn a profit of 18 basis points, right? So this is the type of triangular arbitrage that we'll talk about in the lecture next week, as well as in the tutorial next week, okay? So given that we only have 7 minutes left, I'm just gonna brief you through what we're gonna do next week. So as we mentioned before, we are going to go through the two types of arbitrage that we introduced today next week. And in particular, we'll be focusing on triangular arbitrage, yeah? Let me just wrap up the lecture by introducing the microstructure of the spot exchange rates, spot exchange market. So microstructure means the mechanics of a market, right? So how the market works, basically. So as we mentioned before at the start of the lecture, for the foreign exchange market, we have a dealer market, meaning that dealers will quote a bid and ask rate, right? So it's not an automatic market like the Australian Stock Exchange, for example. So with a bid and ask rate, the dealer can change their bid and ask rate based on their expectation about the future value of the currency, as well as based on their perception about the riskiness of the foreign exchange market, right? So similar to any of other financial markets, you will see that the bid and ask spread would increase whenever there is more volatility. So when there is more volatility, dealers are reluctant to trade unless they know that the trade will not hurt their position, right? So one way that dealers can, so when dealers are discouraged to trade, they will widen the bid and ask spread, meaning that they will make it less attractive for people to trade with them, okay? Secondly, the bid and ask spread would decrease with the dealer competition. So the bid and ask spread is how much the dealer earn profits when they trade with other people, right? So the wider the bid and ask spread, the more profit that they earn. But with competition, if there are more dealers in the market, they are forced to reduce the bid and ask spread so that they can attract more customers, right? Okay. So finally, with any kind of financial markets, when you have private information, it normally can move the prices in the market, yeah? So with foreign exchange markets, private information is a very important determinant of the exchange rates. Okay. So just to wrap up the lecture, so today we have we have talked about the bid and ask prices. We introduced the bid and ask prices in the foreign exchange market. We also talk about how exchange rates are quoted and how we can calculate cross rates from different exchange rate pairs, right? So as I mentioned before, it's a bit confusing at the start to work through these concepts, especially when you have the cross rates and you have the bid ask spreads at the same time. So it takes a lot of practice for you to be able to familiarize yourself with these concepts, yeah? But it's very important that we we are familiarize ourselves with these concepts before we talk about triangular arbitrage. Okay. So for next week, we will start next week with triangular arbitrage to finish off today's lecture. And then we'll move on to the second part of the foreign exchange market by introducing foreign exchange derivatives, right? So for next week, we'll focus on the forward market, and we will also introduce options and futures, as well as the exchange rate currency funds, okay? Any further questions before we conclude? So as I mentioned before, it's very important to go through the exercises that we introduced in today's lecture, so that you can follow in the next lecture, right? You'll find that these, the calculations that we do today are fundamental for the subject, okay? Okay, so if there is no more questions, can I conclude the lecture for now? All right, so I'm going to stop sharing the screen now, and I'm going to conclude the lecture. Thank you so much, guys, for joining in today. I know it's hard to learn through Zoom, but thank you so much for bearing with me. I'll see you next time, okay?